One candle a day is all you need. What if I told you that you only need to read one candle a day to know exactly which way the market is going to run? Not 12 indicators, not a screen full of lines, one single 4-hour candle. That candle quietly hands you the bias for the entire day, and once you can read it, you stop guessing, you stop chasing, and you start trading like you already know the answer. In the next 20 minutes, I'll show you the whole system, start to finish. Here's my promise, and stick with me, because the real magic is the entry near the end. By the time this video finishes, you'll know how one candle sets your bias, the hidden level inside it most traders never plot, the 4 zones that tell you exactly where to buy or sell, and a dead simple 3-step entry that kills hesitation. No hype, no guarantees, just a repeatable routine you can run every single day and then go and live your life. The one rule, your 4-hour candle sets the day's bias. Let's start with the simplest, most powerful rule in the whole system. Take the last completed 4-hour candle. If price breaks above that candle's high, your bias for the rest of the session is bullish, you're only looking to buy. If price breaks below that candle's low, your bias is bearish, you're only looking to sell. That's it. One line in the sand that tells you which side of the market to stand on for the entire day. Why does something this basic actually work? Because that candle is a snapshot of where the market last agreed on value. The high and the low of it are decision points the whole market can see. When price commits past one of them, it's telling you which way the order flow has tipped. You're not predicting, you're reacting to a clean, objective signal the market prints for you. No opinion, no bias of your own, just follow what the candle confirms. Which 4-hour candle anchor it to your session? A fair question. Which 4-hour candle do you actually use, since there are 6 of them a day? Anchor it to the session you trade. I trade the New York session, so the candle that matters to me is the last completed 4-hour candle before New York gets going. Pick your session London or New York, and always use the freshly closed candle right before it kicks off. Consistency here is everything. Same candle, same time, every single day, so your bias is never a guess. And mind your clock. I work on New York time UTC -4, so my candles open and close on that schedule. If your charts run on a different time zone, your 4-hour candles will split the day differently, and your boxes won't match mine. It's not that one clock is right and another wrong. It's that you must be consistent with yourself. Set your platform once, learn where your session candle closes, and never second-guess it mid-trade. The hidden level, the open, and the close. Now, here's the edge almost nobody plots. The open and the close of that 4-hour candle. Forget just the high and low for a second, the body of the candle, the gap between open and close, is a magnet. Price loves to bounce between these two prices, break out, then come back and retest one of them before continuing. That hidden level is what turns a vague bias into a precise place to act. Picture a strong move up on gold. If you only watch the high and low, you often feel like you missed it. There's no clean entry. But drop the close of that 4-hour candle on as a line and suddenly the chart makes sense. Price taps that level, rejects, taps it again, wicks it, and keeps powering higher. It never closes back below. That repeated rejection off the hidden level is the loophole, the market quietly handing you the same entry over and over. It works in reverse just as cleanly. On a bearish day, plot the open and close of that red 4-hour candle, and watch how every little rally up into that hidden level gets slapped back down. Price plays inside the body, breaks lower, retests the level from underneath, fails to close back above it, and continues falling. Once you start drawing this line on your charts, you can't unsee it. Those rejections are the market repeatedly offering you the same short in plain sight. The candle box, 4 quarters that tell you where to act. This is where the system gets really sharp. The 4-hour candle box. Take that one candle and split it into quarters. You can use a Fibonacci retracement or a Gann box. It doesn't matter. You just want the 25, 50, and 75% levels. For a bullish candle, you draw from the high down to the low. For a bearish candle, from the low up to the high. Those quarters turn the candle into a map that tells you exactly how deep a pullback is healthy and where it's gone too far. Let me name the 4 zones so you never get lost. The top quarter, 0 to 25%, is the premature zone too early, often a fake out. The 25 to 50% quarter is the optimum zone. This is the sweet spot we want. The 50 to 75% quarter is the overextended zone getting risky. The market's looking too balanced. And beyond 75%, down to 100, is the danger zone, a flat no-go, because a pullback that deep is disrespecting the move and may reverse. A quick memory tip, so you never draw the box the wrong way. For a bullish candle, you anchor from the high and pull down to the low, so 0% sits at the top. For a bearish candle, you anchor from the low and pull up to the high, so 0% sits at the bottom. Either way, 0% is the freshest edge of the move, and 100% is the deepest. Get the anchor right once, and your quarters line up perfectly every single time. Which quarter to trade the optimum retracement? So which zone do we actually trade? The optimum, that 25 to 50% pocket every time. Here's the logic. In a genuinely strong impulsive market, price wants to fire off a long impulse, take a short breather, then fire again long impulse, short pullback, repeat. A shallow pullback into the optimum zone is the market telling you buyers are firmly in control and only giving sellers a tiny window. That's the easiest, cleanest place to join the move. Now contrast that with a deep retracement that slices into the overextended or danger zones. When price pulls back that far, the market is no longer one-sided. Buyers and sellers are roughly even. It's a coin flip, and your edge evaporates. A shallow pull into the optimum says, buyers dominate, sellers barely got a look in. A deep pull says, it's a fair fight. We don't trade fair fights. We trade the moments where one side clearly owns the market. Previous candle builds the box, the next one is the trade. One thing people muddle, so let me be crystal clear. The candle you draw the box on is the previous, completed, 4-hour candle. The candle you actually trade is the next one, the one forming right now. The finished candle gives you the map. The live candle is where you hunt the entry as price wicks into your zone and shows its hand. Build on the closed candle. Trade the open one. Get that order right and everything else clicks. The breakout and the second entry, your redemption. Once price retraces into the optimum and pushes off it, you'll get the breakout phase price extends clean out of the candle box. That breakout is confirmation your bias was right. The day's committing to the move. If you took the entry off the optimum, you're already in profit and grinning. But here's the part that saves so many traders from FOMO. Even if you missed that first entry, the system gives you a second chance. After the breakout, price almost always comes back to rebalance the box, usually right up at the premature level, the edge of the candle body. That pullback is your second entry, what I call the redemption. The bias is already proven, the move is already running, and the market is simply offering you a discount to climb aboard. So you enter again, or you scale into your existing position, stop below the zone, targeting higher. 2 clean entries from one candle. This is why the model is so forgiving, and why it's brilliant for funded account challenges where one panic chase can blow your whole day. You're never trapped with a single make-or-break moment. Miss the optimum entry? The breakout confirms you were right. Miss the breakout? The redemption rebalance invites you back in. The bias is one decision, made once, and the market keeps handing you fresh, lower-risk doors into the same move. That structure is what lets you trade calm instead of frantic. The IRS model: impulse, range, sweep. To time those entries on the lower time frame, I lean on a simple framework I call IRS, and no, nothing to do with the taxman. It's 3 phases. Impulse, a strong, one-directional burst of candles. Range, a sideways consolidation where buyers and sellers go quiet and price drifts. Sweep, a sharp poke that takes out the liquidity sitting just beyond the range to the stop losses, resting above the highs or below the lows before the real move begins. Why does the sweep matter so much? Because liquidity is fuel. When price ranges, traders pile their stops at the obvious highs and lows. The market dips through one side, triggers that cluster of orders, grabs the fuel, then spins on a dime and launches the new impulse in your biased direction. So when you see a sweep on the lower time frame happen right as price rebalances your 4-hour box, that's your green light. The move is committed, and you can commit with it. The 3-step entry that kills hesitation. Here's the entry I promised at the start. 3 steps, nothing more. So you never freeze with the clock ticking. Step 1. A change of state. On your lower time frame, wait for price to close beyond a clear structural level in your bias direction. A close, not a wick can snap back. A close is the market signing its name. That close tells you intent has shifted your way. Step 2. Wait for a rebalance. Don't jump in on the close. Let price pull back to an unfilled pocket first. The easiest one to spot is a breaker block, a previous order block that got broken, which price now retests from the other side. A fair value gap works too. You're simply letting price come back to you instead of chasing it. Step 3. Enter on the very next candle that confirms the rejection off that level. Stop tucked beyond it. Say that rhythm out loud until it's muscle memory. Change of state, rebalance, candle close. 1, 2, 3. Because the box already did 70% of the thinking, your bias is set, your zone is drawn, the direction is decided. All the entry has to do is time your click. That's why we keep it to 3 steps. Too many moving parts and you'll freeze while the candle runs away from you. Simple survives contact with a live market. Clever doesn't. Candle shape body over wick, or skip the day. One filter decides whether the whole setup is even worth taking. The shape of the candle you build your box on. You want a big, decisive body, a candle that's mostly body with small wicks. That tells you one side committed hard and the day has a clear personality to follow. A fat green body wants to keep going up. A fat red body wants to keep going down. That's your engine. Now the candle to avoid. A skinny body with long wicks on both sides. That's indecision. In candle form, neither side won. The market's confused, and if you build a box on confusion, you'll be 10 times more confused trying to trade it. On those days, don't force this model. Either sit on your hands or switch to a different approach built for choppy conditions. Discipline isn't trading every day. It's only trading the days the candle gives you a clear story. Bullish worked example US 100 step by step. Let's walk a bullish day on US 100, the Nasdaq index. The last 4-hour candle closed as a strong green body, so we draw the box from its high down to its low and mark our quarters. Price opens the new candle, drifts sideways for a bit, that's the cold engine starting, then dips into the 25 to 50% optimum zone. That shallow pull is exactly what a strong market should do. The hidden level, the candle's close, holds price up and refuses to let it close below. Now we drop straight to the 2-minute for the entry. No fluff, no in-between time frames. Price impulses, ranges, then sweeps the liquidity below the range lows just as it rebalances our box. There's our IRS. We get the change of state as a candle closes above the local structure. Price rebalances off a breaker block, and we enter on the next candle. Stop below the recent low, target the session high for a clean 1 to 2. Price spirals up and tags the target. Done before lunch. Bearish work example xauusd the same way. Flip it for a bearish day on xauusd. The last 4-hour candle closed as a strong red body, so this time we draw the box from the low up to the high. Pre-market already looks heavy, so the bearish bias is no surprise. Price opens, manipulates upward into the optimum zone, that little fake push that traps late buyers, then stalls right where we expected. The hidden level caps it. Price fails to close above the previous candle's close. That's our tell. The skill isn't worshipping one setup. It's reading the conditions and picking the right one. That flexibility is what turns a trader from someone with a strategy into someone with a business. But for everything we're covering today, the rule is simple. If the 4-hour candle is a big decisive body, and the market is clearly impulsing, the box is your weapon. If it's indecisive and balanced, holster it and wait. Knowing when not to use a tool is half of mastering it. Why it actually works, the cold engine start. Step back, and here's why all this holds together. Price never starts the day aggressive. It builds momentum slowly, like a cold car engine turning over before it accelerates. A fresh 4-hour candle opens indecisive, drifts, sweeps a little liquidity, retraces to the optimum, and only then spikes away. That whole rhythm is just accumulation, manipulation, then expansion, the power of 3. You're not predicting magic. You're reading the same warm-up the market runs every single session. And because it's the same shape every day, it becomes a routine instead of a gamble. You check one candle, draw one box, wait for one zone, take one clean entry, and you're out, often inside an hour. No staring at screens all day, no revenge trades, no FOMO. Because if you miss the first move, the redemption entry is right behind it. The market prints this structure for you. Your only job is to wait for it and follow. Stack the odds align with the bigger picture. The candle box is powerful on its own, but it sings when it agrees with the bigger picture. Before I trust a bullish bias, I want the daily and the higher 4-hour structure leaning the same way, making higher highs and higher lows, not fighting an obvious downtrend. A quick glance at pre-market tells you the mood too. If everything's already heavy and bearish, a bearish candle bias is confluence, not a coincidence. Trade the box with a bigger trend at your back, not in its face. One warning, so you don't overthink it. Align with the recent, relevant structure, not ancient history. Don't talk yourself out of a clean bullish day because of a monthly order block from 6 weeks ago, or because price should reverse at some level that's already been rejected 3 times. You're not trying to call the top for the next year. You just want your slice of today's move, and then you're out. Recent context decides the day. Old levels are noise until price proves otherwise. Risk, stops, and targets keep it boring. Let's talk about the part that actually keeps you in the game. Risk. Your stop goes beyond the level that invalidates the trade under the recent low for a buy, above the swept high for a sell, or behind the protective fair value gap, never inside the noise. Then, size the position so that if that stop gets hit, you lose only 1 to 2% of your account. Fixed percentage, every trade, no exceptions. The setup picks the direction. Your risk rule keeps you alive long enough to let the edge play out, down to the lower time frame. Price impulses down, ranges, then sweeps the inducement high above the range, grabbing the stops of everyone who bought the fake push and rolls over. Change of state as a candle closes below structure. Rebalance off the breaker. Enter on the next bearish candle. Stop above the swept high. Target the prior low. Price gets trapped under the optimum level and spirals straight down to take profit. Same model, opposite direction, identical steps. Be nimble. This is a tool, not a religion. Here's a mindset shift that'll save your account. The candle box is one tool, not the only tool. Some days, the market simply isn't impulsive. It's ranging, gappy, or chopping sideways with no clear bias. On those days, forcing a continuation model is like bringing a hammer to a job that needs a screwdriver. Have a second approach ready for balanced, range-bound conditions, and the discipline to recognize which kind of day you're in before you draw a single line. On targets, keep it equally boring. A simple 1 to 2 risk, 1 to make 2 taken at the obvious session, high or low, is more than enough to build an account over time. You do not need to catch the entire move. You need to catch your piece and bank it. If you want more, the cleanest way to add is the redemption entry. On the rebalance, not holding and hoping. Take profit at logical structure, log the trade, and walk away. Boring, repeatable, and that's exactly why it works. 3 mistakes that break this system. Before the recap, dodge the 3 mistakes that wreck this model. 1. Trading the wrong quarter. If you buy a deep pull into the danger zone because it looks cheap, you're fighting a market that may already be reversing. Stick to the optimum. 2. Entering on a wick instead of a close. The change of state needs a candle to close beyond structure. A wick is a tease. A close is a commitment. Wait for the close every time. 3. And it's the quiet killer, forcing a trade on an indecision day. Some sessions the candle is all wick and no body. The bias is mush, and there simply is no clean setup. Sitting out is a position. The traders who blow up aren't the ones who miss a day. They're the ones who manufacture trades that were never there. 2 or 3 clean candlebox days a week will out-earn 20 forced ones. Patience is the strategy, not the boring bit around it. Let's lock it in. 1. The last 4. Hour candle sets your bias. Break the high, buy. Break the low, sell. 2. Plot the hidden level, the open and close, and watch price respect it. 3. Split the candle into quarters and only trade pullbacks into the 25 to 50% optimum. 4. Use the IRS sequence and the 3-step entry change of state, rebalance, candle close. 5. Only take decisive, big body candles and take the redemption entry if you miss the first. That's the entire system on one candle a day. If this gave you a clearer way to see the day, do me a favor, subscribe and turn on the bell, because the next video takes this exact box onto a live chart and walks a trade from blank screen to closed position. Tonight, open any pair, draw the box on yesterday's candle, and just watch how price respects those quarters. No money on the line, only your eyes learning. And remember, this is education, not financial advice. Trading carries real risk, so manage it and keep every trade to 1 to 2%. I'll see you in the next one. The closest thing to reading the market's mind. Here's the truth almost nobody tells you when you start trading. The market doesn't move because of indicators, news, or some magic line you drew. It moves for one reason: big money buying and selling. And supply and demand is the one tool that lets you see exactly where they did it. Master this, and a bear chart starts to feel like you're reading the market's mind. I've traded supply and demand for years, and in the next 20 minutes, I'm handing you the whole framework, how to mark zones the way I actually do it, how to stay on the right side of the trend, the one filter that throws out most of the rubbish zones, and a refinement trick that can literally double the reward on the exact same trade. Stick with me to the end, because that last trick is where most of your edge is hiding. Why price actually moves big money versus you and me. Every candle on your chart is just the footprint of a fight between buyers and sellers. But not all buyers are equal. There are two crowds in any market: the institutions, banks, hedge funds, central banks, and retail, which is people like you and me trading from a laptop. Here's the part that changes everything. Retail is a tiny slice of the daily volume. The institutions are the ones with the size to actually push price. So our job isn't to fight them, it's to find their footprints and follow. And the scale here is genuinely hard to picture. The global foreign exchange market now turns over about $9.6 trillion every single day. That figure is from the most recent central bank survey in 2025, and it's up roughly 28% in just 3 years. Your stop loss is a grain of sand on that beach. That's not meant to discourage you. It's meant to reframe what you're doing. You're not moving the ocean, you're a surfer reading the swell the big players create. Supply and demand is how you spot the wave before it breaks. Forget the gold coin cliche, let me give you a cleaner picture. Imagine a limited release trainer, only a few hundred pairs made. The moment demand spikes and supply is almost gone, the price runs because whoever holds a pair can name their number. Now a warehouse turns up with 10,000 more pairs. Suddenly, they're everywhere. Demand cools, and the price drops like a stone. That swing between scarce and wanted versus everywhere and ignored is supply and demand, and it's the exact engine behind every move on your chart. What a zone really is: discount to buy, premium to sell. So what does that look like on a chart? A demand zone is simply a discount, a price level where buyers stepped in hard before, so it's seen as cheap. A supply zone is the opposite, a premium, an expensive level where sellers dumped. Picture buying gold at 2,300. It rips to 2,400. If it ever sags back to 2,300, you see a bargain, and you'd happily buy again. Flip it. If your 2,300 buy ran to 2,500, that's a premium. If price climbs back there, you'd gladly sell. Pull back into demand, we buy. Rally into supply, we sell. And this is the same instinct you already have in everyday life. If your favorite jacket is normally 200 pounds and it drops to 120 in a sale, you don't panic, you see value, and you buy. If it suddenly gets hyped up to 350, you'd think about selling yours on. Institutions do the exact same thing with currencies and gold, just with far bigger size and far more discipline. Demand is their sale rail. Supply is their resale market. Your whole job is to find where those rails sit and queue up on the right side of them. How I mark zones: the last candle before the impulse. Now the part everyone gets slightly wrong. The textbook says, mark the last down candle before an up move for demand, or the last up candle before a down move for supply. Fine, but I don't do it that way, and I think mine is cleaner. I use the last candle before the impulse. An impulse is just a big, decisive move, a run of strong candles in one direction. The single candle right before that explosion is where the real positioning happened. That last candle is almost always an indecision candle. Wicks on both sides, a small ranging body. Buyers tried up, sellers tried down. Nobody won. But on the very next candle, the market detonates. Why? Because that's the final spot where the big orders were sitting before they fired. So instead of guessing, I mark that candle as my zone, the prime pocket where the mass buying or selling actually took place. Backtest both methods if you like, but this is the one I trust. Quick way to tell control. Look at a candle with a big wick above and a big wick below that closes near the middle, that's indecision. Now compare it to a long candle with almost no wick, closing right at its low, that's pure seller control, no argument. When that controlling candle kicks off a sell-off, the indecision candle that sat just above it becomes your supply zone. The last place institutions sold before the drop. Trade with the trend, buy demand up, sell supply down. Here's where most people blow up. They sell every supply zone they see, even in a screaming uptrend. Don't. The single biggest filter on supply and demand is the trend. If the market is printing higher highs and higher lows, you only buy demand full stop. You can use supply zones as targets, but you do not sell them because price will run you over again and again. Look at any uptrend, and you'll see supply zones everywhere inside the small pullbacks, at every little stall. They almost never hold because the dominant force is up, so we ignore them as entries. We buy this demand, we buy the next demand, and we leave every supply zone alone. Now flip the chart. In a downtrend, lower highs, lower lows, you do the exact reverse. Sell supply, ignore demand. Buying demand in a downtrend just feeds you losses. It won't carry you to meaningful new highs. How do you know the trend has actually flipped rather than just pausing? One word: structure. In an uptrend, the moment price closes a candle below the most recent higher low, that's your warning. The buyers have lost control, a break of structure to the downside. Until that happens, every dip is just a discount and you keep buying demand. Don't preempt the turn, and don't marry the old trend either. Let price confirm with a clean break, then trade the new side. Reading structure is what keeps you from selling the bottom and buying the top. A full work trade on gold entry, stop, target. Let's put it together on xauusd, the 4-hour. Say gold has just shifted from lower lows into a fresh higher high, a clean break of structure. That tells us the trend is now bullish, so we're hunting demand, not supply. Above us, there are a couple of supply zones from the prior drop. Do we sell them? No, that's fighting the new trend. We drop our eyes to demand instead. Now, there are several demand zones in this leg, but most are useless because they've already been retested. Push, pull back, tap, done. No imbalance left. The one that matters is the extreme zone, the deepest demand, furthest from price, down at the origin of the whole impulse. That's where the consolidation sat before the big move up, and crucially, it still has open imbalance above it. That's our level. Marking it can be fiddly because the origin candle has a long lower wick. Simple tip: extend the demand box down to cover that low. As long as price doesn't close beneath that low, the zone is valid, and we're fine for a new bullish leg. So now the plan is patient. We wait for gold to pull back into that extreme demand, and only then do we look to buy. No chasing, no buying mid-air. We let price come to our level. Entry is mechanical. a buy limit sitting on the demand zone. For the stop, I don't hug the zone too tight. I tuck it under the next significant structural low, the last higher low before the move. That gives price room to wick through the zone a touch without knocking me out, which honestly happens all the time. Yes, it's a slightly wider stop, but on the 4-hour, that's the safer, more durable choice. Now the target, and here's the neat twist. We use supply against the trend to find it. We scan left for the nearest supply zone that still has open imbalance one price hasn't already eaten. That zone acts like a magnet. In a bull trend, price tends to keep grinding up until it fills imbalances and retests old supply before any real reversal. So even though we'd never sell that supply, it's the perfect place to take profit on our buy. Play it forward and it's clean. Gold dips into the demand. You see those long rejection wicks as buyers slam it back up and momentum kicks in. Price doesn't just tag the previous high. It drives straight into that supply we used as a target. On a setup like this, you're looking at roughly 5 times your risk. Risk 1%, bank around 5. 1 demand entry, 1 supply target, trend at your back. That's the whole game in a single trade. A live read applying this to gold right now. Let me make this real with where gold actually sits as I record. After topping out near 5,597 back in January 2026, gold spent months in a corrective phase and has been trading around the 4,300 area, with a clear structural support pocket down near 4,200. Notice the language pocket, not line. That 4,200 region is exactly where I'd be hunting a fresh, unfilled demand zone if the higher time frame trend turns back up. Levels move. So check your own chart when you watch this, but the method is identical whatever the number reads. Here's how I'd frame the bias without guessing. Drop your 2 main moving averages on as a quick trend gauge, say the 50 day and the 200 day. When I checked, the 50 day sat around 4,432 and the 200 day near 4,623, both above price. Price under both averages tells you the medium-term pressure is still down, so I would not be forcing longs, yet I demand a clean break of structure to the upside first, then go hunting demand. The averages don't give entries. They just keep you honest about which side to favor. So the playbook writes itself. I wait. If gold reclaims structure and starts printing higher highs above those averages, I switch to buying the freshest demand with open imbalance, quite possibly that 4,200 pocket, or wherever the next valid zone forms. If it stays heavy under the averages, I flip the whole framework and sell supply on the way down instead. Same 3 questions every time. What's the trend? Where's the unfilled zone? And is there a trap above it? The asset and the number change. The questions never do. Inducement, the trap zone that trains retail to lose. Now the concept that separates traders who get it from traders who keep getting stopped. Inducement. When you've got 2 demand zones to choose from, the higher one is often a trap. It looks like a perfectly good place to buy, which is exactly why it's dangerous. It baits retail in, then price slices straight through it on its way to the real zone below. Why does price ignore the upper zone? 2 reasons. First, the imbalance we keep talking about is pulling price lower toward the deeper consolidation. Second, and this is the big one, liquidity. Look just under that upper zone and you'll often find equal lows, 2, 3 lows resting on the same line. Retail reads that as support and piles in long, stacking their stop losses right underneath. That pile of stops is a pool of orders, and markets are magnetized to orders. Price isn't going to bounce cleanly off a level when there's a juicy cluster of liquidity just below begging to be hit. Far more likely, it dips through the equal lows, triggers all those stops, and only then reacts from the true demand zone underneath, where the real institutional buying lives. So the upper zone is inducement. The lower zone with imbalance is the truth. Buy the truth, not the bait. Confluence stack the odds before you click buy. A zone on its own is a decent trade. A zone with confluence is a great one. Confluence just means several independent reasons pointing at the same level. The first I always want is higher time frame agreement. If my entry zone is on the 1 hour, I want the daily and 4 hour both saying up. Top down beats bottom up every time. Read the big picture first. Then drill in for the entry, never the other way around. The second layer is timing. When you trade matters as much as where. The big, clean impulses tend to fire when London and New York are active, because that's when institutional volume actually shows up. A pretty zone tapped in the dead of the Asian session, on thin liquidity, will often just drift and chop. So I'll happily wait hours for price to reach my level inside a live session, rather than take the same zone when the market's half asleep. The third is a clean approach. The best zones get approached in a straight, greedy line price, runs away from them fast, and leaves that imbalance we love. The worst get nibbled at, retested 2 or 3 times, chopped through slowly. When you see price grinding sideways into your level, instead of leaving it in a hurry, that's the market telling you the zone is weakening. Stack trend, timing, and a clean approach on top of an imbalanced zone, and you're no longer guessing, you're trading where everything agrees. Refining zones, the trick that doubles your reward. This is the part I told you to wait for the biggest edge in the whole video. Refining zones. Same trade, same idea, but you tighten the entry so your reward explodes. Take that gold demand on the 4 hour. It's a chunky indecision candle, a wide box. Drop down to the 1 hour and look inside that single 4 hour candle. You'll almost always find a smaller, cleaner indecision candle with its own fresh imbalance the last candle before the impulse, 1 time frame down. Here's the magic. That 1 hour zone is about half the height of the 4 hour box. Keep your stop in the same place, still under the structural low, but bring your entry down to the tighter 1 hour level. Suddenly, the distance from entry to target is bigger, and the distance from entry to stop is smaller. On our gold example, that pushes the reward from roughly 5R, to closer to 7R. On the exact same move, you added serious profit without touching the chart's outcome, just the precision of your entry. And it compounds through position size. Half the stop distance means you can use double the lot size for the same dollar risk the same 1%, but on twice the position. So a trade that paid 5% can pay 10. A 7R idea can become 14R. That is the single highest leverage habit in supply and demand. Refine the zone, half the risk, double the size, same dollars on the line. One warning so you don't overdo it. Only step down 1 time frame at a time. Daily to 4, hour 4, hour to 1, hour 1, hour to 1, 5 minute, that's the rhythm. Jump from the 4 hour straight to the 5 minute, and you've over-refined. Your zone gets so tiny that normal noise stops you out before the move even starts. Refine with respect, not greed. 4 mistakes that quietly drain accounts. Before we wrap, let me save you some pain with the 4 mistakes I see most. Number 1, trading against a trend because a supply zone looks juicy. In an uptrend, that's just donating to the market. The trend is the filter, respect it or pay it. Number 2, buying a zone that's already been retested. Remember, a zone is good once. If price has tapped it before, the imbalance is gone, and the edge with it. Number 3, zones drawn too fat. If your box is enormous, your stop is enormous, and a single loss wipes out 3 wins. That's exactly what refinement fixes. Tighten the zone, tighten the risk. Number 4, and this one's a killer. Moving your stop loss because you feel the trade will come back. The moment you start negotiating with a losing trade, you've stopped being a trader and started being a hostage. Set the stop at entry, then leave it alone. Tie those together and you get a simple rule of thumb. If you can't say out loud why the trend, the imbalance, and the clean approach all agree before you click, you don't have a trade, you have a hope. Hopes don't pay. A checklist does. 2 or 3 good setups a week that tick every box will beat 20 rushed ones every single month. Patience isn't the boring part of this strategy. Patience is the strategy. Your practice plan for this week. Theory you don't drill is theory you forget, so here's a plan you can start tonight. Open any pair you like. Gold, Euro USD, GBP, JPY, doesn't matter, and scroll back in time so you can't see the future. Mark the trend first. Higher highs and higher lows, or lower highs and lower lows. Only then start hunting zones, and only in the direction of that trend. Do this on a chart where the answer's already played out, so the market grades your homework for you. Then, run each zone through the checklist out loud. Is it with the trend? Does it have open imbalance? Or has it already been tapped? Is there inducement and liquidity sitting above or below it? Could I refine it 1 time frame down? Mark your entry, stop and target before you scroll forward, then reveal the outcome and see how it played. Do 20 of these and you'll spot a valid zone in seconds, not because you memorized a rule, but because your eyes have actually seen it work 20 times. Let's lock it in. 1. Price moves on big money buying and selling, and zones are their footprints. 2. Mark the last candle before the impulse, not the textbook candle. 3. Trade with a trend buy demand in uptrends, sell supply in downtrends, never against. 4. Only take zones with open imbalance and dodge inducement by respecting liquidity below. 5. Refine 1 time frame down to double your reward. Get those 5 right, and you're already ahead of most of the market. If even one of those clicked for you, do me a quick favor, hit subscribe and turn on the bell, because the next breakdown is where I take this exact framework onto a live chart and walk a trade from blank screen to closed position. Open your charts tonight. Mark 3 zones using the last candle before the impulse method, and check each one for open imbalance. That 10-minute drill will teach you more than a week of theory. And remember, this is education, not financial advice. Trading carries real risk, so manage it. Keep every trade to 1 to 2%. I'll see you in the next one. While knowing more keeps making you less. Right, let me show you something before I explain a single thing. This one gold trade banked a clean 3-to-1, and I found it in under 20 minutes on a bear chart, running the exact same routine I go through every single morning. No 12 indicators. No 6 screens. No sitting glued to the charts from open to close. And here's the part nobody wants to hear. The reason most traders never get consistent isn't that they know too little. It's that they know too much. Every new indicator, every new strategy, every clever little tweak I bolted on over the years, almost every time, my results got worse, not better. The day it finally clicked was the day I binned about 90% of it and traded one repeatable pattern, the same setup, the same checklist, the same execution, every day. It felt almost too simple to work. But stick with me, because by the end of this video, you'll be able to run that exact 5-step checklist yourself. And I'll walk you through the live gold example where every box lit up at once. The promise what you can actually do after this. So here's the deal for the next 20 minutes. First, I'll show you why piling on knowledge quietly wrecks most accounts. Then, I'll give you the whole routine in order. How I map location before I even think about an entry. How I filter the news in 90 seconds. The one signal that tells me a move is exhausted. And the 2 bits of confirmation I wait for before I click. Then the entry mechanics. The maths that lets you win less than half your trades and still come out ahead. And finally, how you grow this from a tiny starting stake without blowing up. Keep an eye out later. I'll freeze on the exact candle that got me into that gold short, so you can see precisely what I was looking at in real time. Why more knowledge made me a worse trader? Let's be honest about the trap first, because you're probably standing in it right now. Trading feels like it should be hard. We're wired to believe that a market this big, with this much money sloshing about, must need something complicated to beat. So we go hunting. A new indicator this week, a new candlestick pattern the next, a fresh strategy off someone's channel the week after. And every one of them feels like progress. It isn't. The traders I've watched struggle the longest are almost always the ones with the busiest charts and the fattest notebooks, hopping from setup to setup, convinced the next thing they learn is the missing piece. The missing piece was never another indicator. It was subtraction. The turning point for me was giving up on trying to catch everything the market does, and instead choosing one clean, repeatable moneymaker and running it to death. Same location, same trigger, same risk. I stopped caring about the 50 other moves I could have caught, and for the first time, my equity curve stopped looking like a heart rate monitor. Simplicity isn't a compromise here, it's the edge. A rules-based routine kills decision fatigue. It kills the emotional pull to chase, and it kills the self-sabotage that comes from making it up as you go. Step 1. Location before entries map the higher time frame. So here's the routine, in order. Every morning I open one chart, and I do the least glamorous thing in trading first. I mark location. Notice I said location, not entry. Most people open the chart already itching to click. I don't touch a 1-minute chart until I know where price is on the bigger picture. For gold xauusd, my main instrument, I start on the 4-hour. I'm looking for the zones price has reacted to before, where sellers stepped in and knocked it back, where buyers absorbed the drop and lifted it. Those repeated reactions are your resistance and support zones. And note the word zones, not lines. The market doesn't respect a single thin line. It respects an area. Now here's why this matters more than usual right now, and it's a live example you can pull up yourself. Gold went absolutely vertical into late January 2026 and printed an all-time high up around the $5,600 region on the 29th. Then it did what parabolic moves always eventually do it, snapped back hard, shed a big chunk of that rally, and by early July, it's been grinding sideways, roughly in the 4,200 to 4,200 area. That context is your bias. When a market is chopping sideways in a range, the highest probability assumption is that it keeps doing that until proven otherwise. So, as price pushes up into the top of that range, into resistance, I'm leaning toward a fade, a reversal, not a breakout. I treat the market as most likely to carry on doing what it's been doing, and I put the odds at roughly 80% that the current behavior continues. That single assumption stops you fighting the chart. Practically, I draw a small handful of things, and no more. The obvious high of the range and the obvious low. The overnight high and low, because London and New York love to hunt those. And if there's a clean sloping line the swings keep respecting, I'll add a trend line, an upper resistance trend line on a rising wedge, say. That's it, 4 or 5 marks. This map does one job. It tells me where to expect a reaction. So when price sprints into that zone, I'm not surprised I'm ready. If you draw 20 levels, none of them mean anything. Draw the few that price has actually paid for. Step 2. The 90-second news filter. Before I look for a single entry, I check the calendar, and it takes about 90 seconds. I use a free economic calendar, filter it to the currency I care about, and I'm only asking one question. Is there high-impact news due today that can move gold, and when? That's it. In this market, that means the big US data jobs, inflation, anything Fed-related, plus anything the central bank chair says on the wires, and the geopolitics that have been jerking gold around for months. Take last week as the perfect example. US jobs came in soft, markets slashed their bets on the next rate move, and gold ripped over 2% in a session. If you're short into a number like that, without knowing it's coming, you're not trading, you're gambling. Knowing the schedule doesn't mean you trade the news, it means you're never ambushed by it. Step 3. The exhaustion signal. The unhealthy move. Now the fun part. Price has run into one of my zones great, but a level touching isn't a reason to trade. Strong trends smash through levels all the time. So I wait for the market to tell me the move is running out of fuel, and I have one simple tell for that, an exhaustion move, or what I call an unhealthy move. Picture it. Instead of climbing in orderly steps, price suddenly lurches one big, greedy candle, far bigger than everything around it. That imbalance leaves a gap, a pocket where price moved so fast it skipped over fair value. On a chart, it shows up as a fair value gap. And the thing about a move that violent is that it's usually unsustainable. The market tends to come back and hand most of that candle straight back. This is my catalyst. When price pokes into resistance and does it with one of these ugly, overextended shoves, I get very interested because it flags a clean snapback. One honest warning. Though an exhaustion move on its own does not mean the trend is dead, plenty of times price fills the gap, catches its breath, and carries on trending. I'm not betting the whole trend flips. I'm betting there's a high-quality reversal to trade, and I only take it when the next piece lines up. And a quiet note that'll save you money. These setups tend to pay faster on the short side, because gold sheds altitude far quicker than it gains it. Fear moves faster than greed. When it goes, it goes. Step 4. Confirmation. The structure shift plus failed retest. Here's where most people jump the gun, and where I used to hand my money away. When I want a reversal, I'm effectively calling the end of an uptrend and the start of a downtrend, and that is genuinely hard, so I refuse to guess it. I wait for the market to prove it to me. And the proof is written in the structure. An uptrend is just higher highs and higher lows, stacked. The moment that changes the first lower low, then a lower high, the character of the market has shifted. That's my third box. But I still don't click. I want one more thing. I want price to try to continue up and fail. That failed continuation is the whole game. After structure breaks, the market will usually throw one more push higher. It traps the last buyers, who think the uptrend's still on. If that push stalls and gets slammed back down by a big rejection candle, that's my green light. Think about what just happened. Buyers tried, buyers failed, and they're now trapped above me. That's exactly who fuels the move down as they bail. So my fourth box is a failed retest right under a lower high, capped by an obvious rejection candle. When I've got the zone, the exhaustion, the structure shift, and the failed retest 4 boxes, I'm finally allowed to think about an entry. If any box is missing, I don't trade. And if the whole day never lines up, I close the laptop and go and live my life. No setup, no trade. That discipline is the strategy. Quick one if this is lending. Quick pause. If the checklist is starting to click, do me a favor and tap the like button. It genuinely helps the channel put these breakdowns in front of more traders who are drowning in indicators. Right, back to it, because now we get to the click and the maths that makes the whole thing work even when you're wrong more than half the time. Step 5. The entry and the maths that carries you. Let's talk about the actual click, because how you enter matters. I don't sit there with a market order twitching to buy the exact tick. Once I've got my failed retest, I place a sell stop order a touch below that rejection low. A stop order does something a limit order can't hear. It only triggers if price actually trades through my level and confirms the breakdown. If price never breaks, I never get filled, and I've risked nothing. If it breaks, I'm in the moment momentum agrees with me. On that gold example, price rejected the lower high, rode over, and my order triggered as it sliced back below the minor support underneath, right as the door opened into that empty pocket the exhaustion move left behind. Those pockets fill fast because there's very little volume in the way. Now the maths, because this is what lets ordinary people trade for a living. I only take reversals that offer at least 1 to 2, and I love a clean 1 to 3. Risk 1 unit to make 3. Why does that matter so much? Because it means your win rate can be genuinely mediocre, and you still make money. At 1 to 3, you only need to be right about 3 times in 10 to break even. Everything above that is profit. Flip it around. If you trade a lousy reward to risk, say risking 100 to make 50, every single loss now costs you 2 wins to repair, and that is brutal on your head as much as your account. I've lived on the wrong side of that maths, and I'm never going back. Put the numbers in your favor, and let a 30 to 40% win rate quietly grow the account. Managing the trade without giving it all back. Getting in is half the job. Not giving the profit back is the other half. My stop goes just above that failed retest, the level that would prove me wrong, and my first target is roughly 2 times that risk, usually the range low or the overnight low sitting underneath. If I'm honest, this is where beginners should keep it boring. Set a fixed target at 2 or 3 times your risk and let it hit. Managing a fast trade, live, by feel, is a skill that takes time. Don't start there. On the gold short, my first soft target was the prior lows. The moment price got moving, I trailed my stop down behind each closing candle, because on a clean break, every 1-minute candle can be worth a chunk, and I refuse to watch a 3R winner turn into break-even. There's a subtle shift here that matters more than any rule. Don't only think about your reward to risk, think about where you are in the move. As price drove into the more major support and the fall itself started to look overextended to the downside, I tightened right up. Because the same exhaustion logic that got me in short now warned me a bounce could be coming the other way. Around 3R, I'll happily bank a chunk. If it's still printing lower candles with force, I'll let a runner breathe. 2 questions run the whole exit. Is the reward still worth the risk from here? And has this move started to look exhausted itself? When the answer flips, I'm out. No hero trades. Scaling from a tiny stake the same way. Let's talk about growing this, because the honest version is less sexy than the adverts and far more likely to keep you in the game. You do not need a big account to trade this. Start on a demo always, when you're learning a platform or a new setup, and prove to yourself you can run the checklist for a few weeks without deviating. Only when the routine is boring and repeatable do you go live, and you go live small. The number that matters isn't your position size, it's your risk per trade. Keep it to 1 to 2% of the account, full stop. That single rule is what lets you survive a losing streak, and you will have losing streaks even with a good system. Scaling then becomes almost boring, which is the point. As the account grows and your execution stays clean, you increase your position size in small, deliberate steps, not because you're feeling brave, but because 1 to 2% of a bigger balance is simply a larger number. The setup never changes. The checklist never changes. The routine still takes 45 to 60 minutes around the session that suits your time zone. For a UK trader, that's the London Open and the New York overlap, which is where gold does most of its damage anyway. You can run this alongside a full-time job. What grows is the account, not the complexity. Please hear this clearly, though. This is a skill you build, not a lottery ticket. There's no guaranteed number. Results vary, and anyone promising you certainty is selling you something. The exact numbers on that gold short. Let me put real numbers on that gold trade so it isn't just theory. Price pushed up into my resistance zone in the upper half of the range, through the exhaustion candle, then broke structure with a lower low and gave me a failed retest right under the lower high. I placed the sell stop a few pips below the rejection low. Entry filled around the break. My stop went just above the retest high. Call it a 30 pip risk on the setup. First target was the range low sitting roughly 60 pips below, so 2R. And the runner went for the overnight low beyond that, which is where the 3R came from. Same maths, whatever the account size. If I'm risking 1%, that trade returns 3%. If the stop had hit, I'd have lost one and moved on. No drama, no revenge, next setup. Same checklist, different pair GBP/USD. And to prove this isn't a gold-only trick, run the identical checklist on GBP/USD around the London Open. Perfect for a UK trader. Because that's when cable actually moves. Say sterling rallies into an obvious overnight high that also lines up with a session resistance zone. Box 1, location, tick. It gets there with one greedy candle that gaps away from the packed box 2, exhaustion, tick. Then it prints a lower low, rolls a lower high, and the push back up fails on a fat rejection candle, boxes 3 and 4, tick, tick. Sell stop below the rejection, stop above it, target the prior session low for 2R. Nothing about the process changes. The pair changes, the levels change, the time of day changes, the 5 boxes do not. That's the whole point of a repeatable system. You carry it, not 100 separate setups. The two mistakes that quietly kill this system. Even with a clean checklist, 2 habits will bleed you, and I've done both. The first is overtrading, forcing a setup on a day that never offered one. Your brain hates a blank day. It whispers that surely there's money out there you're missing. There is, and it's not yours to take. If the 4 boxes aren't there, sitting on your hands is the trade. The second is meddling with your stop in the wrong direction, nudging it wider because you feel the reversal is still coming. The instant you widen a stop to avoid being wrong, you've abandoned the plan and turned a defined risk trade into an open-ended one. Move stops to protect profit, never to postpone a loss. Practice this week the 3-0 setup drill. Here's a drill you can actually do this week, and it's the fastest way I know to trust a system. Open the gold or cable chart, scroll back, and hand count 30 examples of the full 4-box sequence. A zone, an exhaustion candle, a structure shift, a failed retest. Mark where you'd have entered, where the stop sits, and where 2R and 3R land. Don't trade a penny yet, just log the outcome of all 30. What you're doing is proving to your own eyes that a 30 to 40% hit rate with these payoffs comes out ahead, so that when you're live and you take 3 losers in a row, you don't panic and rebuild the whole strategy. Conviction doesn't come from a guru telling you it works. It comes from you watching it work 30 times with your own hand. One last habit that ties it all together. Keep a one-line journal. After every trade, win, lose, or the days you correctly sat out, write a single sentence. Did all 4 boxes show up? Yes or no? Did I follow my exit plan? Yes or no? That's it. Within a month, you'll spot your real leak. And I promise you, it won't be your entries, it'll be the days you forced a trade that wasn't there, or the stop you widened when you should have taken the loss. You can't fix what you don't measure, and one honest line a day measures the only thing that matters. Did I run my own process, or did I improvise? Trade the process, log the process, protect the process. Everything else is noise. The 5 boxes, one more time. So let's lock it in. 1. Location before entries. Map the few zones price has actually paid for on the higher time frame, and let the range give you your bias. 2. The 90-second news check, so you're never ambushed. 3. Wait for an exhaustion move into your zone that overextended candle that leaves a gap. 4. Demand a structure shift and a failed retest before you even think about clicking. 5. Enter on a stop order. Risk 1 to make 2 or 3. Protect the profit and size at 1 to 2%. Miss a box, skip the trade. That's the entire edge, not more knowledge, just the discipline to do the same simple thing, well, every day, before you go. If you got value from this, subscribe and turn on the bell. The next breakdown drops every week, and I'll be taking one clean setup at a time and pulling it apart the same way. Drop a comment with a pair you want me to map next. Gold's my home turf, but I'm happy to run the exact checklist on GBP/USD or the indices too. Go and mark your zones tonight. Run the checklist on demo tomorrow, and let the boring, repeatable version of trading do its quiet work. And the important bit, none of this is financial advice. Trading carries real risk. You can lose money, so manage your risk at 1 to 2% per trade and never risk what you can't afford to lose. See you in the next one.